when a geopolitical event gets worse over time. So the big concern now, of course, for people, for the world, for geopolitics, is whether the situation in the Middle East right now could easily see a situation where the war expands. That would be a positive for gold.
Adrian Day, the founder of Adrian Day Asset Management, recently delved into the global economic landscape, highlighting its fragility, especially in light of the ongoing conflicts in the Middle East and the potential risks of a worldwide economic slowdown. Adrian offered insights into the challenges the Federal Reserve is poised to face, the increasing appeal of gold and silver in 2024, and the looming specter of a debt crisis. Gold prices have surged to a 2.5-month high, with escalating turmoil in the Middle East driving up demand for the precious metal. Investors are also closely monitoring U.S. Federal Reserve Chair Jerome Powell's impending speech, which is expected to provide crucial economic and monetary policy insights. Adrian emphasizes that gold has a track record of performing well during robust rallies, irrespective of the geopolitical situation in the Middle East. He also underscores the Fed's potential response to the changing economic landscape. As Federal Reserve officials deliver speeches throughout the week, market participants will be attentive to any signals regarding future interest rate policies, making this a noteworthy period for financial markets. Adrian also underscores the Fed's potential response to the changing economic landscape. According to Adrian, the Fed may need to halt its tightening measures, including raising interest rates, even as inflation remains a concern. This shift is pivotal for the performance of gold, but could also have repercussions for the U.S. dollar's value. The dollar was mixed on Monday before a week heavy with speeches by Federal Reserve officials that will be watched for further clues on interest rate policy and as investors monitored developments in the Middle East. Before diving into Adrian Day's insightful interview, subscribe to our channel and give this video a big thumbs up.
I think it's important that we realize that, gold, in my view, was set for a strong rally, regardless of what happened in the Middle East.
Right.
Geopolitical events, when you look at gold and geopolitical events, they tend to have a relatively short-term impact on gold, with two exceptions. One exception is when gold is already in a very strong up move, and then a geopolitical event just pushes it even higher, such as the Iran hostage crisis in 1980. And the other thing, of course, is when a geopolitical event gets worse over time. So the big concern now, of course, for people, for the world, for geopolitics, is whether the situation in the Middle East right now expands. Does it bring in Iran? Either Iran comes in or uses Hezbollah to start a second front for against Israel. It looks pretty clear that countries like Egypt, Saudi Arabia, probably Jordan, don't want to get involved.
Right.
But you could easily see a situation where the war expands. That would be a positive for gold. But if it's a relatively contained issue, Israel goes into Gaza, wipes out Hamas, takes control of Gaza, that probably would see the rally in gold, the geopolitical rally in gold, peter out. But as I say, we're getting very, very close to the point where, the Fed is going to have to stop tightening, even as inflation starts to move back up again, which I think it will next year. We saw the numbers last week, of course. And I think we're going to see the inflation numbers move back up because of the impact of the higher oil price over the last 2 or 3 months, which has an impact on everything, on all the goods in the store, not just on transportation and gasoline, but it affects the price of everything in the store. So as the price of as inflation numbers move up, but the Fed is unable to tighten more, then that's the pivot point for gold. And we're getting very, very close to that. Two other factors play into that. One is the geopolitical situation, because of course, typically in a geopolitical crisis, gold and the dollar are the two two assets that benefit.
Mm-hmm.
You get a flight to the dollar, and we saw a bit of that last week. The other thing, of course, will be what are other central banks doing? Now, if we saw a period earlier in the year where the Fed was kind of slowing a bit, but the European Central Bank was continuing to hike and talking tough, and that's positive. That's negative for the dollar, positive for the euro. I suspect that if the Fed's not going to come out and announce we are not going to raise rates again.
Right.
But once it's clear that the Fed is not raising rates, I suspect the European Central Bank will take that as an opportunity for them not to raise rates. Now, what I'm trying to say is that if all central banks around the world stop hiking, then that wouldn't have much of an effect on the dollar in and of itself. But if Britain, Canada, Australia, Europe, if they raise rates after the Fed has paused, then that would be negative for the dollar.
Prominent billionaire investor Ray Dalio has sounded a cautionary note, predicting that a looming debt crisis will grip the United States. During a recent interview, Dalio pointed to concerning projections indicating that the U.S. national debt is set to surge to over $52 trillion by 2033. This escalation in debt is compounded by the increasing portion of the federal budget allocated to servicing interest payments on this debt. The current state of the U.S. national debt has raised alarm bells. The extensive spending in response to the COVID-19 pandemic has driven the budget deficit to levels reminiscent of those seen during World War II. Adrian underscores that the U.S. government continues to issue additional debt to cope with the expanding budget deficit, which is further compounded by the need to address delayed auctions during the lockdown period. The U.S. government carries trillions of dollars in debt owed to various foreign entities, encompassing foreign governments, central banks, corporations, and individual investors. As of January 20th, 2023, foreign countries possess a significant $7.4 trillion in U.S. treasuries, constituting approximately 24% of the total U.S. debt. However, according to Adrian, traditional purchasers of U.S. debt, such as the Federal Reserve and various foreign countries, including China, Japan, and Russia, are reducing their acquisitions.
This is getting dramatically worse this year and next year, because over the next, first of all, you've got the increased issuance, Treasury issuance on the increased deficit. There's no sign the deficit's going to get reduced anytime soon, right? There's no particular will. I mean, we've now got the part of the Republican Party wanting to control spending, but I would ask where were they when Trump was in office? But so you've got the increased issuance because of the increased deficit. You've also got increased issuance this year for the balance of this year because of the treasuries that were not issued for suspended auctions during the lockdown talks, during the debt ceiling talks. So we've still got that to come in, probably another $1 trillion or more before the end of the year, an additional. But in addition to that, you've also got an estimated 30% of all outstanding treasuries that are going to roll over in the next 12 months.
Wow.
That count came from Paul Tudor Jones. 30% of all of the outstanding treasuries are going to roll over in the next 12 months. So you have got an enormous amount of treasuries being issued, again, over the next 12 months.
Wow.
Both, for the first half of next year. Again, that reverts back to one of my bugbears, which is why the Treasury did not issue longer term bonds when rates were so low. But that's in the past now. They can't do much about that now. So you've got a huge amount of issuance, and that, of course, is increasing the amount of payment on the debt service. Mm-hmm. At the same time, you've got a shortage of buyers. And we saw this last week with the 3-year, the 10-year, and the 30-year were all weak.
Right.
I think it's probably an exaggeration to say they're all failed, but they were certainly all very weak. And so that's because the traditional buyers are not in the market right now. Who are the traditional buyers? Well, the largest buyer of treasuries for the last 30 years has been the Federal Reserve itself. And the Fed is no longer buying. So if the Fed's not in there, China, Japan, and Russia, which traditionally have been the 3 largest foreign buyers of bonds, They're not in now. US banks have severely reduced the amount of longer term treasuries they're buying because of the problems they had with the mark-to-market, which caused the banking crisis in March. So they have severely reduced their buying. And so the remaining buyers and the new buyers, which are pension funds, insurance companies, and then what we'll call investors generally, which includes a lot of hedge funds, they're going to demand higher rates. And we saw that last week. And so not only are we having more treasuries issued, but the market is demanding higher rates for the market to clear, to buy those. And yeah, to your point, that's just going to increase the amount of debt service phenomenally. Where does this end? It ends with a weaker dollar, I suspect. It has to end with a weaker dollar. In the nearer term, we'll probably see in some backdoor fashion.
In this era of increasing global economic fragility and geopolitical turmoil, what strategies and measures should be considered to navigate the looming challenges, including the potential debt crisis and shifts in monetary policy? Share your thoughts in the comment sections. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.